Well, it ended up being a mixed week. We checked a lot of the boxes that we were looking for in terms of positive tech earnings, a rate cut at the FOMC meeting, and a good resolution to the US-China trade dispute. But we also got a few things that we were not counting on, like an ultra-hawkish Jerome Powell, who threw cold water on the idea of another rate cut coming in December, and that trade agreement between the US and China being temporary and being renegotiated every year. So while we did make good progress on a lot of fronts, we did not get the exact clarity that markets were hoping for moving into November. This has made for a challenging trading environment with many names hovering between key support and breakout levels, and no sector exemplifies this more clearly at the moment than crypto. So let's dive in to look at the key charts for stocks, commodities, and crypto to discuss the week that was and to determine the outlook for the month ahead as we move into November. Let's go. This isn't financial advice. Past results are not indicative of future performance. Do your own research. Welcome back to The Trading Apologist. My name is Tom, and I hope you all had a good week. My sincere apologies for posting the video late this week. I did hit some snags on my travels home and got back a day later than expected, but I am here now. Before we dive in, if you do find value in the content, likes, comments, and subscribes are very much appreciated to help me get this channel off the ground. Now, before we discuss the macro, we do have one more earnings week coming up, and this will be the last major week for earnings of this season. Monday, we have Palantir and HIMS to look out for. Tuesday, we have Uber, AMD, Shopify, Hut 8, and Axon. Wednesday, we have Robinhood, Celsius, Novo Nordisk, App11, ARM, Figma, Unity Software, and IONQ. Thursday, we have D-Wave, The Trade Desk, Opendoor, Oscar, Iris Energy, SoundHound, Moderna, and Airbnb. And lastly, Friday, we have Constellation Energy. It is going to be a busy week out there in the world of earnings. Now, everyone on X has been talking about the dreaded Hindenburg Omen, and yes, it is named after the 1937 blimp disaster. Very ominous. Now, the Hindenburg Omen is a market breadth indicator that flashes when both 52-week highs and 52-week lows occur in unusually high numbers on the same day across markets. It signals internal conflict and instability beneath the market's surface. Now, this omen, it basically means that markets can't decide. Strong names are making new highs while others are breaking down. Historically, clusters of these signals have preceded major pullbacks a la 1987 and 2008. But the signal has also appeared during normal consolidations, and the last two instances of the signal actually saw the market moving higher for another 3 months before a correction, which actually could align well with the thesis we've been discussing of a correction coming in early Q1. Now, institutional behavior doesn't yet suggest that there is panic in markets. M&A activity remains strong, bond demand is high, and volatility hasn't spiked in a way that typically it would before a major market crash. What we are seeing instead is a market that is losing structure, not necessarily confidence. It's a rebalancing more than a collapse is the way I would think about it. And the challenge now is staying tactical as traders, reducing exposure in overextended areas, and using shorter term trades while the foundation firms up. In essence, I would say it's not time to panic because the why behind the signal is often more important than the signal itself. And we still have a rally that is being led by true earnings, not hype and vaporware. This is not the same as the dot-com bubble. Now, there are real cracks under the hood that we need to be aware of too to balance out our view. And the only one I'll touch on today, because we looked at more of them on Monday, that really shocked me is the $29.4 billion that the Fed quietly injected into the banking sector today. Now, on Monday, we already discussed the $3 billion that was added on the 24th of October, which had brought the monthly total to $14.7 billion and the yearly total to $33.5 billion. Well, we just about doubled that in a single day. something is clearly going on in the banking sector that we need to be weary of. And while Jerome Powell said that they were not stopping QT until December and didn't really hint at QE starting anytime soon, it has clearly already been going on quietly in the background. Maybe not clearly, they're trying to hide it, but we know what's going on. Okay, with all that indecision and these ominous signs, let's get into the charts to look at what the key setups are that we need to pay attention to in the week ahead. Okay, starting here on the S&P 500, and I've just got all this text marked up for the last couple of weeks in our Patreon. I've been updating this occasionally, just noting the market reaction at these key inflection points. So we can marry up the price action to the narrative that's out here. And you can see on Wednesday, this was when we had that hawkish Jerome Powell, and the market has drifted down a little bit towards the end of the week. But the good thing is, this is our price action from last Friday, and we had that gap up over the weekend. We didn't fully close the gap, but when we pulled back on Friday, we bounced exactly off that previous swing high from last Friday. So that was a great point to see a bounce. That was at about 68.40. If we were to fully close this gap from the closing candle from last Friday, that would have us closer to 68.20. So just a little bit down below. But all in all, in terms of how this structure is shaping up, the most likely path forward is just another higher low as we continue on in this steady grind. And we are now in all-time high territory. And just as a reminder, because, it has been a challenging month in certain names while others have outperformed, but, many names are down 20+%. If you're in Chipotle, you're down 50%. Sorry, I didn't mean to laugh at Chipotle, but Chipotle and Carvana, I think, is another one that just has gotten destroyed. But I want us to remember how strong we've been in this rally, and we've had two bearish engulfing candles on the weekly that have recovered the very next week in both these instances. And sorry for the messy text cluster here as we go out to the weekly. But it is worth remembering that any time in recent history over the last couple of years that we've seen a bearish engulfing candle, it has led to at least 2 more weeks of correction, sometimes 3 more weeks of correction before recovery. So that just shows you how darn strong we are right now. And if we do get a more meaningful pullback, look to the 20 weekly, this pink line, which normally plays support, which is where the street steps in. Sometimes we dip a little bit below it, but just as a general guide, the 20 weekly, if we pull back there, is a safe place to buy. And the reason I bring that up is if we go over to the NASDAQ, just to illustrate this strength, we have been up for 7 months in a row now. Now, we are on the 5th strongest run in market history for the NASDAQ. I think the record is 10 months up in a row. And as we know from our GAN swing analysis, any move over 7 bars in one swing has a much higher chance of a correction and more likely a sharper correction. So it is something we should look out for in the months ahead, particularly if we get over 9 bars. That 7 to 9 bar range is where you really start paying attention and getting a bit more defensive. And we do that a lot on a daily chart. This is playing out on the monthly chart. So I still maintain that November is most likely going to be positive, but maybe later in December or early January we see that correction. And on the NASDAQ, you can also look to that pink line. I mean, it'll be a different color on your chart, but it is pink on mine, which is the 20 weekly moving average, which here we're seeing on the monthly scale. But if we just go out to the weekly on the NASDAQ, obviously this was our tariff correction here. But if we're seeing these general uptrends, yes, we wick below it, but that is where we normally see the street, Wall Street, step in to buy. And the yellow line here, where we get a lot of those bounce points from on the sharper corrections, that's the 200-day moving average. So those are both good ones to keep up on your chart. Okay, in terms of stronger sectors, semiconductors have remained strong. Actually, surprisingly, quantum names were quite strong this week, going up on days where you saw the NASDAQ going down. So we'll look at those a little bit later. But it is certain sectors that are moving and others that are very much underperforming. SMH is still on its way to our 100% extension target up here at 407. We had a nice move up, mostly led by NVIDIA this week. TSM stalled out a little bit, and now we're consolidating. If we flip over to the NVIDIA chart, we can see that reflected there as well. That breakout and a couple days of consolidation, which is totally normal. Markets don't go up in a straight line. The two most common things we see in markets are these impulsive moves, and then corrective moves, which is all that sideways chop. So markets spend 80% of the time figuring out where they want to go, 20% of the time getting there. The impulsive moves are that 20% of the time that's exciting. So expect a little bit of chop, but the ultimate price target, if NVIDIA does 100% extension, which is going to be a big ask for an asset this large, 200 was a zone for resistance. 220 would be the next overhead. Then we have 250 to 260 as the 100% extension here at 260, which would take this, I believe, I'm just trying to do the math in my head, but to over a $6 trillion asset, which is unbelievable. If we do look briefly at TSM didn't have that same breakout, but it has been consolidating, and our price target for TSM is still at that $337. So watch this to see if it can break out from its consolidation zone this week and catch up to NVIDIA. And apologies for all the extra lines. I was trying out a couple things and experimenting, and I should have deleted those before recording the video. Okay, if we do look briefly at Micron has been outperforming. It's gotten past its price target at 170 at the 100% extension. So let's just bring in the fib extension tool to see where the 1618 and the 2618 are. Give me a second. We have our 100% level here, which, hold on, let me sharpen this up a little bit. All right, there we go. Okay, we have our 100% level here at 170. Our 1618, we already blew past that at 213. So this has really been outperforming. If it can make it to the 2618, which you don't see very often, normally it's the 100% extension or the 1618 that get hit, that would take us to $280 on MU. Just unbelievable the run that this one has been on. Okay, I'm gonna front load the video with a couple of new names that I'm excited about. And the first one here is BILI, which is it's fun to say, so it has that going for it. But the best way to think of this is the YouTube of China. And it has made a wonderful recovery since 2024, where it was at $8. We are at $30 now. But it is still a long way off from its all-time highs. And right now, what I'm looking out for is a breakout of this range. So if we just connect all these highs right here, you can see that we are just about to test this trend line for a potential fourth time breakout, which, I mean, this has already been recovering, but sometimes those fourth time breakouts can be explosive. Now, on the daily, our volume has been dropping off, and we are overextended on some metrics. As you can see, the RSI is quite high here. If we look at this on the weekly, just for comparison, the weekly actually has room to run in terms of mean reversion and RSI, but it is also fairly extended, and this can fluctuate quite a bit. If we just extend where the clouds of the confluence model upper band are, this really could pull back all the way down to $23 and still be in a bullish trend before attempting that breakout. So watch this one. If it presents any good entries, you can try to front run a breakout with this momentum, or you can wait for confirmation on that breakout itself. And this is another one that does have earnings coming up, and these are on the 13th of November, so not this week, but the following week. So most of the exciting earnings are behind us, but this one will still be reporting the week after this coming week. All right, the other chart I'm excited about, which isn't as exciting an asset, is CL, or Colgate-Palmolive. And the reason I'm excited for this one, and let me just bring in the raw price action here without RSI and mean reversion, is because we are just back testing a breakout zone. If you look at this trend line where we had a 1, 2, 3, fourth time breakout before this explosive move from about $80 all the way up to $109. And this is a consumer staple brand. This isn't a tech company. It's not going to percentage-wise do the same moves. Now we've come back and we just actually on Friday on earnings back tested that breakout zone. We wicked just a little bit below, but it had a good bounce away on the close. And we also have a bit of a falling wedge shaping up right here, which that is drawn horribly, where we could map out some price targets. So if this continues the bounce on Monday, this could be one that it just technically is a very, very clean chart setup. I haven't seen a clean setup like this in quite some time. And if you break below this trend line, close multiple days below there, it's time to exit the trade. But we also have on that bounce on Friday a massive volume candle, which could confirm that reversal. So look at this one on Monday, see what it did over the weekend, and it could be worth a trade, because it doesn't move too much percentage wise and it takes some time to get there. This could be one worth playing just with simple call options to help amplify those returns. Okay, let's move into the stars of the week, the tech names, and we'll start here with Amazon, which, we were saying looked good already last week, well, the last couple of weeks, and we had that breakout from our local downtrend right here, moved away, didn't get a full back test, and just rocketed away on earnings. Now, Friday, after that massive gap up over $30, we gapped from 222 at the close all the way up to 250. There was a lot of selling on Friday, which makes sense in terms of profit taking, fresh highs compared to our peak back here in January of 2025. But we almost came back to test those previous all-time highs. So I don't know, actually I don't think this gap is going to close, but if we come back down a little bit more, that might be the best entry you are going to get on Amazon for a while. And if we are looking to the local 100% extension, that would have our target up here at $287 for Amazon for that near-term move. Now, if we got all the way up to the 1618, that would have us at $330 roughly between the 150% extension to the 1618. And the reason I bring that up is if you do a fib extension of this larger swing from the 2022 low, we have a key level up there at around $330 on that fib extension as well. So there's a lot of confluence in this zone, and I'm actually looking to that for an eventual target for Amazon. All right, Google also on earnings saw continuation of its breakout, and Google led the way. It broke out from its consolidation zone before earnings, just setting the stage for that. Also saw some selling to end the week. Didn't quite close the gap, but it got close. So if you get to 274, 275, that would be a decent level to consider an entry. Now, if we take our 100% extension and rather than the fib extension, I'm just going to do this based off of a price and time extension off this trend line. So we have a sense of when that should hit and where it should hit. So that would have us targeting roughly $350 by March of 2026 for Google as that price target. Now, Google, we have to be a little bit careful with because on the daily, we're getting a bit overheated again on the RSI. This can run a fair bit longer, but it'll eventually need to cool off. And on the weekly, we are getting quite elevated. And if we look at previous weekly highs for Google on the RSI, you can see we rarely get above this level at about 83.3. So this will be a good one just to draw a horizontal line on your charts, just to get you to pay attention to when we get into that zone, that it probably won't have too much more to run on the weekly beyond that zone, just based off of Google's history. And, that doesn't mean it's going to come crashing back down, but it might have to take a breather along the way and consolidate. But since this one is overextended and mean reversion has deviated, there's a bit more risk that selling could step in, even though the earnings were good for Google. The fundamentals look better. They don't have debt like Meta. They don't have let's say, some money furnaces hanging on like Microsoft does with OpenAI. So things are generally looking positive, but just from a charting market structure perspective, things are a little bit overheated. So there is risk that either selling could step in or this could just consolidate for a bit to let the charts cool off. Okay, now I'm going to bring up Microsoft, not because I'm trading it, but just I think we should all look at these names. And Microsoft saw that bounce up and then saw selling. Now, this is on the weekly, and we do have a mean reversion dot and RSI elevated to the weekly or on the weekly as well. And the thing I'm looking to right now on Microsoft is this potentially being a double top. I mean, it's uncanny how close those wicks are up in price. And so if we just measure this out in terms of a potential target, we draw that neckline over the top, and then we draw from that intervening valley to that high right there, and we project this off the bottom. Where would get us price-wise? That would get us right to $430. We're currently at $517, and I always like to look left on the chart and say, does this price target make sense? And this one, to me, makes a lot of sense because it aligns with all these previous highs in this consolidation zone. And if we bring up the VRVP, the point of control is right below there at 414. So these price targets, think of them as a range, not an exact dollar and cent number. And you can, especially on an aggressive sell-off, deviate a bit below that. But this price target would not be activated unless we break this intervening low, which is sitting at about $493. So if Microsoft breaks that low, then expect this as an eventual price target. And if you do want to play the short side of the market or we see a correction, that could be one where at least you have a clear exit to look at. Okay, and last one of the tech names, just to recap the earnings week, Meta got the most beat up because their revenues were dropping. They had a one-time tax burden that definitely brought down their overall earnings, but we are getting into support, and I just took a small position on Friday. Now, in terms of position sizing, my Google and Amazon positioning would be much larger than Meta just because of the inherent risks with Meta and revenue slowing down. I think they can turn things around with their new ad business, and I think they are going to cut their CapEx spend before too long, but the market is having flashbacks to all that unnecessary spending on the metaverse that also just turned into a bit of a cash furnace for them that didn't really see any ROI. But in terms of where we're just about to the 50%, which is sitting at $637. We got to $650 on Friday, so it was close enough, decided to take a little position. And the reason I did that too, from this double top, which is a bit off, it's just within tolerance percentage-wise, but that double top had a price target of that 650 number, so I thought, okay, the target's been hit, we'll most likely wick down to this level, and that 50% is my invalidation zone. I would probably add a little bit to my position there, but if we close daily candles below the 50%, we have these previous wicks testing it from the underside, any close really below 630 would be my line in the sand to say, okay, get out of this trade. Meta clearly isn't doing well and is rolling over. But with this large volume candle, these often lead to reversals. I thought it was enough to at least take a shot at a trade. And I would love to see actually a gap down on the open to this 50% and then a move away early next week. So keep your eye on Meta. There could be an opportunity for a trade in it. But in terms of just analyzing the fundamentals of the companies, I would much rather be in Amazon and Google right now out of the four. Okay, I'm going to keep this one brief, but I exited my PayPal trade this week, pre-market at just above $80. I think I got out at $81 pre-market, and they had a positive earnings reaction, new partnerships with OpenAI and a few different things going on. And in true PayPal fashion, selling stepped in and got us all the way back down to support at $67. Now, I wasn't paying attention to this on Friday. I wanted to honestly re-enter a position because I think this is eventually going to break higher. But in terms of just a little 12-day trade and getting over 20% on that, it wasn't bad. But this one is volatile, and it was a small conviction, or a small position, all things considered. I do think it's going to recover. It could go to 90 or 120 eventually, but it's not the play I believe in the most. Let's say it that way. Okay, one more that has earnings coming up on the 6th of November, so this Thursday, and that is XYZ or Block or Square, Jack Dorsey's company, whatever we call it these days. And this has been consolidating since July in this very tight range. And you might be predicting a little bit here, but considering the way everything else has broken, and since we entered this from the underside, it seems like this one is going to break up, and the price target, if we do break this range to the upper end, would be $109.68. So let's say $110 from this range break. So it's one to keep your eye on. If you don't want to, predict a play, you can just wait for earnings and you can react to that. But it's one that is providing the possibility for a good trade setup with that extension. Okay, let's talk Bitcoin, and we're going to flip the script this time and start with the short term and then go to the long term. Looking here on the 4 hour, we have clear resistance overhead at this $116,000 level. And on the low end, we've definitely been making higher lows on the way up. I didn't love on Thursday that we broke back down below the 200-day moving average. Now we're just hovering above and have been flatlining all weekend. The smaller time frames suggest that volatility is incoming, and I imagine we would see that on Sunday afternoon. I would really, because crypto is kind of on the last lines of support for smaller crypto names, Bitcoin could still go down to 95 to 98K and be okay, but I would love to see a bounce away and a move above that 116K level. Really, 116K is level 1, and then 118K and closing above that would be the next line in the sand to really get us recovering, and that would have us above these previous swing highs. If we can close daily candles above 118K, then I would say we're going to retest all-time highs. And the broader thesis for Bitcoin is if we see all-time highs past November 29th, that would put us over 5% past the time target for that 1,064 days of a traditional Bitcoin bull run. So statistically, it's probable if we see a fresh all-time high past November 29th that the cycle is in fact extending. But in terms of the weekly candle and monthly candle, on the weekly, we are still holding this trend line break, barely, but we are holding it. And if we look to the monthly, we narrowly avoided a bearish engulfing candle on the monthly. So if we would have closed below 108,000, we would have had a bearish engulfing candle, which would not have been a good sign, but we narrowly avoided that. So I know hope isn't a strategy, but keep your fingers crossed for Bitcoin and crypto. There's just feeling that drag of the traditional 4-year cycle. Everybody's familiar with the timing. It's causing a bunch of natural selling. People don't want to get stuck in the same position they were in at the end of 2021, and we're seeing that sell pressure. And one side or the other is going to have to win out eventually. Okay, if we're looking to Solana, we are still in this symmetrical triangle, just barely holding on to support. But on the daily, we have been printing mean reversion dots. And the only thing I don't love is how much we're testing the 200-day moving average and this trend line. Eventually, the old saying of tapping the glass, eventually it's going to break. So I would love to see a strong move away from Solana or on Solana here. And the best near-term sign of strength would be breaking this next overhead resistance here and really getting above $205, which is this local swing top. But $205 was our key support line that we broke down from on October 10th. And now on the monthly time frame, if we go out to, on the weekly time frame, if we go out to the weekly and we turn on our confluence model clouds, you can see here on the weekly that we had broken below into the center confluence model cloud, got back above, and then broke back down. And that confluence model center cloud is also sitting at $205. So that $205 level, getting above there for Solana is going to be the first step to having us on the road to recovery, assuming we can do that. And in terms of the weekly RSI, we broke out from this and we are just barely holding on. I mean, we can sharpen that up a little bit, but we kind of are cheating. We're right on the line, if not below it. So seeing a strong weekly close, if this can rally tomorrow afternoon, would give me a lot more confidence in this recovery shaping up. And if this breaks down, I would be hedging a lot of my crypto position because we've been in this uptrend since April. And a breakdown of this would just hint at lower prices, which to me would be looking at maybe putting some of my crypto in USDC or rolling it into Bitcoin as something less volatile with not as much potential downside as the other crypto names. Okay, I'm not going to cover MicroStrategy today because it is just beholden to Bitcoin. And if Bitcoin is weak, it's probably going to test its underside trend line that we've been looking at really in every video. That's sitting at about 245 right now. But looking to Tesla, Tesla does look like it's breaking this range to the upside and potentially wants to test that 500 to 550 range. Now, we did drop below our breakout again on Thursday, but we bounced from key support at 440 and we closed the week above the all-important $450 level. So look for continuation this week. There is the shareholder vote on the 6th for Elon's compensation package. There's been a lot of fear out there about Elon potentially leaving. I listened to both his interviews on Joe Rogan and on the All In podcast on Friday. And he said he's not leaving Tesla. But if the compensation package does not get approved, he would most likely slow development of the Optimus bot because, his justification is he wants at least that 20 or 25% control so he can have a meaningful vote in shaping the future of that and having some control over the robot army, as he affectionately referred to it. So that will be a big inflection point on Thursday. If that vote goes positively, that could be the catalyst that would send us to those higher prices. But I still anticipate volatility in the future. So if we get to 500 or 550, I would not be surprised if Tesla on some event early next year came all the way back down to 420 or even all the way down to 370, 380 underneath. So, the volatility has not dried up here and it is a wonderful vehicle for trading as well as a longer term hold. Okay, I'm going to try to be a little quicker. I want to bring up Celsius again because, we had the one trade from January that we exited just a couple of months ago in August, and then we had some selling. But if we go into the 4 hours, so this a couple of weeks ago looked like a massive cup and handle that was confirming, and we've sold off a little bit since. We've not broken down entirely yet, but the one thing that I am considering, if we go into the 4 hour and see all the price action, we do have a potential double top in play. So if we start closing daily candles below $60, really we just closed barely above that on Friday, or actually right on it. But if we start closing daily candles below $60, I would consider exiting my near-term position to see if this would drop down further, drop below this local low here at 50, which would confirm then the target all the way down at 33 which would be a massive drop on Celsius. I don't know what would have to happen to get us there, but in terms of does it make sense, it unfortunately does make sense as a target because it aligns perfectly with the previous lows and this spike up in terms of what supported this long consolidation range from March all the way through May of this year. Okay, one more that has earnings coming up this week, actually right away on Monday, is HIMS. And HIMS, I was in a little bit of a trade. I was going for a bounce play off the 200-day moving average. And once we started drifting down again, and on the daily time frame actually, we closed back below the Confluence Model Center Cloud. I got out of that moving into earnings. I just thought, this is a little bit risky moving into earnings. I don't love holding fresh positions right into earnings. But the other thing I'm thinking about is we have major support just below at 40. And I'm wondering if on earnings, we get a wick down to 40 and then a bounce away. Sometimes with earnings, you see an initial reaction that's not the right one and then a bounce. a bounce at 40 would be a fantastic sign because that would put HIMS in this larger trading range, and it would not have us breaking really any of these previous swing lows. If 40 fails, the next support underneath is at 35, which it could recover from, but then we're breaking structure just in terms of a higher high, equal low, lower high, lower low, then presumably we're going to get another lower high, and that could turn into something more. It's just going to have more work to do if it does drop below 40. So watch earnings, watch the reaction. Trading is great on HIMS, but what this does here, if it bounces, I would say, it's still a safer, like longer term hold that could have much more upside. And then we could look for a fourth time breakout of the range to the overside. But if this fails down to 35, it seems like it's going to take HIMS a bit more time to get its footing. Okay, one more that we are in on a trade on, which is Unity Software. Now, we have earnings coming up as well this week on Wednesday. It seems like we have been forming a bit of a base. We haven't fully recovered and turned the trend yet. And honestly, I was looking on the 4-hour. If we draw in the 4-hour, and what in the world happened to my trend line, guys? Let's sharpen this up because something did not go right. All right, there is our trend line now, all nice and dressed up again. So in terms of testing this trend line, we have not done that yet. And I'm wondering if on earnings we get a final little drop down, and I would love to get an entry. That would be around $34. I would have loved to get entries around 30, but this is a longer term hold for me. So I'm just looking to add on any dips, but just watch for volatility coming into that event. And if we are looking on the daily, just in terms of this falling wedge breakout, we are targeting 65 as a near term target, and near term, I mean over the next few months. And we have printed mean reversion dots on the daily. So more upside is the probable path here for Unity. Okay, really briefly looking to CoreWeave. CoreWeave has been holding on stronger than the rest of the market. So something worth considering. And I'm wondering if this is forming up a little flag that could get us higher to $160. I exited my trade actually at about the exact price we are at right now. As this was breaking down, I thought it would have dropped a little bit lower, didn't get back in, but I might get in my position again just for this breakup and to see if we can mount a bit more of a recovery on CoreWeave. There are some things in the fundamentals that I'm a little bit concerned about, but in terms of the truth being in the charts, there's clear strength in this compared to other names right now. So I also don't want to fight that, and I'm happy to be along for that ride. All right, if we look at Circle still has been a little bit weak. We broke our trend line and now are back testing it from the overside. The one thing that is shaping up that's worth watching out for, we have this very even neckline that is giving us a bit of a head and shoulders. And normally I look for head and shoulders, at the tops of trends, but they can sometimes be a continuation pattern in a downtrend, or an inverse head and shoulders can be a continuation pattern in an uptrend. But because of that horizontal neckline, I'm paying attention to it, and that would have a potential downside target at about $84. So if we break down below 118, particularly if we break this trend line, I would be looking to exit my calls on Circle because they are expiring in January of 2026. So I don't have much time on them. And rather than roll them, I would most likely close them and then look again to re-enter if we do hit a price target like this. But in terms of indecision in markets, this is a perfect example where the falling wedge is giving you a price target here, you start recovering, then a bunch of indecision and chop, and at least we have a line in the sand of if this underside support at $120 fails, we know what we need to do. Otherwise, we are assuming most likely we will be able to mount a recovery. Okay, this video is getting far too long, so just looking at the quantum space in this fashion here, you can see for a volatile sector, it held up really well this week and outperformed the NASDAQ on Thursday. QUBT is in a bit of a weekly range. If you go out on the weekly on this, it's just been really range bound here. But RGTI and D-Wave did recover and break out a bit more. So those are the sector leaders. IONQ, which is one of the biggest names in the space, this has earnings on Wednesday. That's one to watch out for. Hasn't bounced quite as much, hasn't shown as much strength, but IONQ earnings are going to impact the rest of the sector. So that's why it's something to pay attention to this week. Okay, last two names from the Patreon community watch list will go to AXON. And this name broke out from, I'm on the weekly. Let's go back to the daily because it might be giving us a chance to enter. We broke out from this downtrend and now are just selling off a little bit on Thursday and Friday. So look for an entry anywhere around 715, actually 715 for this gap close would be a fantastic entry if it gets back down there. And then you would have to assume between 710 to 715, it is going to bounce. This is one that I am keen to get into for a little bit of a medium-term play, and I just didn't get the fills I wanted at this trend line. I was really hoping we would retest this trend line that has played support during the entire bull market, and we just didn't quite get there, but maybe we'll touch it in the future. And also, this one has earnings coming up on Tuesday, which could be a catalyst. Maybe that gets us to the trend line and we get a much better entry. But another one to watch. I don't love trading into earnings, so I'm just going to take the wait and see approach on this one as well. Okay, and last one from the community watch list, which is REGN, which had the breakout we were talking about this week on earnings. So we were talking about this consolidation range and how it looked like it was going to break to the upside. We got exactly that. And now we are into the next overhead fib level and really a resistance zone in terms of these previous lows back here from February of 25. That support zone from February of 25, now potentially playing a bit of resistance. The daily chart got overheated on RSI and mean reversion spiked up. So I would imagine that this is now going to consolidate for a bit, maybe pull back slightly before the next move higher, but you have a clearly confirmed uptrend on this, and it has a long way to recover, with the all-time highs being at $1,200, and we are currently at $651. So even just getting back to the 50% of the range would put us at 842. So the upside there, and I normally assume that these things will get at least to the 50% level after such a big and extended pullback. That would be about a 30% move to the upside there on REGN. All right, so that is it for the charts. As we're going into the week ahead, let's just remember there is indecision out there in markets. The trading environment remains challenging, but I think that will resolve soon. Obviously, the Hindenburg Omen and many other cracks underneath the hood are having investors worried. Also, we're to the end timing-wise of the crypto traditional 4-year cycle. But all of that is just one piece of the puzzle. Market deterioration, yes, it is real beneath the surface, and it will eventually be something that we need to deal with. But currently, we have liquidity. M&A activity is continuing. Demand for corporate bonds. All of these things suggest that we are not yet on the brink of a crash. Now, I maintain that we are going to see a positive 2026, but that it will also be marked by that aforementioned volatility with at least 2 meaningful corrections in the year ahead. So it remains a trader's environment. Focus on relative strength, watch for confirmations across indicators, and as a reminder, the real edge here isn't predicting, it's preparing and having a plan for both sides of the market, knowing what you're going to do if the trades you're in are either breaking up or breaking down. So I look forward to seeing you all on Monday. Hope you have a good remainder of your weekend. Bye for now.